everybody. Welcome. Sorry for a little bit of a late start today. We've been working out a little bit of an audio kink, and I want to say welcome. Appreciate your coming. Appreciate your staying as well. Let's go ahead and kind of get this kicked off today. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So with that being said, I do want to welcome to the room today for the first time Scott Beck. Scott works with TradeSpoon. He does an absolutely fantastic job. Well, actually, this is his first time. We've had Vlad in the room before. They've done some Metastock integrations that are actually really, really cool. And I hope he really talks about that today. But let's go ahead and, Scott, how are you doing today?
I'm fantastic. Thank you. I appreciate the invitation. Glad to be here.
Yeah, I appreciate your patience while we made all of our audio work on this side. So let's go ahead and get the screen share over to you.
Perfect. And let me get this up.
All right.
Okay. Should be able to hopefully see.
Yep. You're coming in. You look perfect. I'm going to get out of the way. Your turn.
Awesome. Awesome. Appreciate it. Thank you again. And thank you guys for coming out, taking some time to hang out this afternoon, get into some, in this case today, talking about some key trading metrics, return on capital, probability of success, estimated move. My name is Scott Beck. I am the head trading coach for TradeSpoon. Let me go ahead and advance my slides. We'll get right into this here. Give myself a little bit of introduction. I've been working in trading for 20 years. I started off working on a trading desk for a large broker. After about 5 years there, 4 or 5 years, I transitioned into the education side of trading, where I've been ever since. I have actively traded in my own accounts for the entire duration of my experience in the market. So I have 20 years of experience in trading and 15 going on 16 years experience in trading education. So that's me. I primarily trade options in my own personal trading. I tend to trade swing trades and a lot of time decay strategies. We have our own disclaimers. Unfortunately, I'm going to just kind of give you the gist of it as I let you read. Same thing. We're not investment advisors. We don't give advice. We're not registered as such. Anytime we talk about any kind of trade pick, it's strictly for illustrative and educational purposes. In any situation as a trader, make sure that you take any trade and make it your own. I need to remind you that I and or the team at TradeSpoon may have a financial interest in the securities presented and any trade picks. Vlad Karpel, TradeSpoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. TradeSpoon and AOS are not affiliated companies, and each firm's material not endorsed by the other. Okay, so with that out of the way, what we do at TradeSpoon and what we try to bring to our subscribers, to our students, our traders, is 7 pillars of profitable trading, right? We want to bring a balanced approach to the market that integrates a number of different facets of trading. Yes, we are known for our charts. Vlad Karpel, our founder, spent a number of years. He's very big in technology. He is very big in trading. And when you put those two together, you get someone who looks to solve the market through quant mathematics. So he developed an algorithm. It is a self-developing algorithm, which means it continues to learn as it progresses. And adjusts to market conditions. That's what we're known for, are the charts, and we'll definitely take a look at those. The indicator. But more than that, we try to provide a balanced look at education, what kinds of strategies you can apply in the market. We take a look at the psychology of the market, mindset, emotions, how they play an impact and how to prevent them from negatively impacting you. We look at risk management. How do you control your risk, justify it on every trade, trading plan development, record keeping, a real balanced approach. And we find that we integrate well with traditional charting software such as Metastock, because like any tool, anytime you're doing something big, like trying to succeed in trading, one tool will never suffice. It's just not going to happen. You're building a big, beautiful house. If you have one tool, it's going to help, but you need multiple tools in order to accomplish the job. So what do we help do? We help choose what to trade, what product, what sector, what strategies, position management. How do we manage risk? How do we adjust during the trade to monitor risk and reward? Avoid chasing the market. We want to make sure we have good technical rules that help us to get in when markets transition. Personally, I try to catch the transitions at or near support or resistance levels anytime I am directionally trading in order to produce favorable reward to risk environment. Be patient, maintain a long-term focus. Again, the psychology of trading, it's very easy to become myopic when we trade, to get caught up in the last trade and what happened there and what can we do from there. Always managing reward and risk. Every day, every decision, every trade, my thought process is from right now, if I stay in this trade, what's at risk? And where does it happen? How do I go wrong? On the other side, how much do I expect to make? And what's the likelihood of that? And that's what leads to today's discussion. When you think about trading metrics, oftentimes people think about percent return. That's their metric. How much did I make? What we're talking about here is, what are the metrics we can apply before we get into the trade that make sure that we build the best trade possible? We always want to manage our reward and risk. And lastly, and this is a very, very important one, I have done a lot of education and coaching through the years. I've been in the industry for over 15 years. I have in various formats between boot camps, webinars, live events, and one-on-one coaching, I've worked with more than 10,000 traders. And I can tell you right now, successful traders do what failing traders don't want to. They don't want to sit down and write a plan, right? You talk to traders and you say, what's your trading plan? And they point to their head. It's all right here, they say. That's not a plan. That's a notion. That's an idea. And if you're willing to go forward and put really, really hard-earned dollars at risk on a notion or an idea, I would be very careful. Turn it into a plan. It's got to be a formal trading plan with rules, and it needs to be written. If it's not written, it's not really a plan. It's not real. So if you haven't taken the time to sit down and really draft your trading plan, and that's something that we help our subscribers with, right? Is how do you take good charts and good tools and put it all together and decide what strategy and what time frame and where's my entry and my exit and my stop and my target and my position size. And when I'm done, how do I log that trade and make sure that I can learn from my own results? There was a saying I came across one time. A guy said, experience is what you get when you didn't get what you wanted. Another way to frame that, a trader one time said, I never learned anything making money. We've got to make sure that we are building a trading structure so that every time we have a losing trade, we are learning as much as we can from it. We don't just lose and walk away. Was it me? Did I do something wrong? Was it the market? Was it my system? But what we're talking about today is really going to be trying to get in front of our trades. What can we think about? What questions can we answer before we take the trade that help us to build the best possible trade? Now, as far as our the TradeSpoon site goes, like I said, what we have is a set of tools unlike anything else. It is projections that are built on very complex, sophisticated mathematic algorithms that produce real-time predictions that look like what we're used to looking at: candles, trends, charts. It gives us an easier way to analyze the chart. It helps to predict prices either for the next hour or for the next 10 days. So we can look at it every 5 minutes or every day. It helps to identify key support and resistance levels. I'm absolutely looking for confluence between the indicator and my traditional technical analysis. And make sure you stick with me to the end. I'm going to give you a link that'll give you 30 days free access to the TradeSpoon site so you can verify all these claims that I'm making. It helps us to see if there's going to be changes predicted for today or for the next 10 days. That's the crux of the tools available. Let's dive into the presentation though. Anytime, and we definitely are oriented. Well, not we. Vlad is definitely a combination of a stock and option guy. Vlad, our founder. I'm an option guy. I trade almost primarily options. Lots of spread strategies that I put into play. Understanding option trades can sometimes be difficult. So when you think about how do I go about building the best possible option trades, again, it's the metrics that we talked about. What is the probability of success, right? Probability plays a huge, huge role in options. Even when we start to look at the Greeks, which are the metrics that are a direct byproduct of a option pricing model, when you look at the option Greeks that come from there, they are integrating probability. So when we look at any given trading scenario, we're thinking about probability of success. We're thinking about the return on capital, and even at a deeper level than that, return on risk. So let's start digging into what we're seeing here. First and foremost, when we think about probability, we think about random distribution of probability. So think back to your college statistics classes when you start talking about 1 standard deviation, 2 standard deviations, 3 standard deviations. Most probability models work off of the assumption of 1 standard deviation, which means we're looking for 68% of occurrences to fall within that range. If you want a higher probability, 95%, that gives you 2 standard deviations. And even more than that, 3 standard deviations, that should encompass 99.7% of events occurring within that range of distribution. Why is that important to us? Because that's what we're trading. We're trading probability. At the end of the day, we are speculators. And some of you aren't going to like this. But when I call you a speculator, speculation is a really fancy word for guessing. You're guessing. You can't predict the future. All you can do is take past patterns and say, I have a certain expectation that this pattern repeats itself, whether it's a candlestick formation, whether it's a technical indicator like a stochastics, a MACD, moving average, RSI, whatever. And there are dozens and dozens and hundreds of technical indicators. None of them are better than any other. If they were, everybody would know. Everybody would find out. Everybody would know. Then they would all start using it. Then it would stop working. They're just perspectives that help us to see patterns. We look for trends, higher highs, higher lows. Why? Because now this one is a little bit stronger. This is the properties, the laws of physics. Things in motion tend to stay in motion unless acted upon by an outside force. We expect trends to continue unless acted upon by volume. We see it break the channel. So what we start thinking is can we build trades where we are putting ourselves in this realm? Oh, let me draw. Oh, I went too far. Let me go back. Where we put ourselves in the realm of probability. Yeah.
What we're seeing is still the very first screen of your PowerPoint.
You're not seeing advancing slides?
No.
Well, that's not good. What about now?
Yeah, now we can see it. That's what we were wondering, if you were had slides that were okay. We can see it now. in advance. Now, I'll let you know.
No, sorry. No. I'm very glad you interrupted. I'm not sure what happened. It looked like it paused my screen sharing when I turned it on. Okay. I don't think let's see. Okay. Now, sorry, we're back into the discussion of probability and standard deviation. So now you can see my bell chart, so it probably makes a lot more sense. What are we looking for? We're looking for events that occur within these deviations, these first, second, third standard deviations of probability. So if I can put myself into a situation where I find a trend and I'm getting in and have a probability of success of 68% of the time it occurs above this level, now I have probability of success coming from trading with the trend, and I have mathematical probability where I have a 68% probability of success because it exists above my support or resistance levels. So let me continue on. Let me just see. I don't think we missed anything else before that. No, we didn't. Okay. Yeah, very sorry, guys. Let's continue on. The concept of probability is best illustrated when you think about a game of craps. I have 2 dice involved. When I throw those dice, what are the probabilities of getting any set of combinations? Well, clearly, 7, which is a very important number in craps, is important because it occurs the most frequently. I can get a 7 between a 1 and a 6, a 2 and a 5, a 4 and a 3 from either combination of dice, which means it's going to happen most of the time. 6 is the second. I can get a 6 from a 5 and a 1, 4 and a 2, 3 threes, right? 2 threes. And so on until we get to where the only way for me to make a 12 is 2 6s. The only way for me to make a 1 is 2 1s. So imagine if I could start making bets in craps where I bet that it's going to be a 5 or higher or a 6 or higher. And imagine if I could get 2 to 1 for my money on those bets. You can see that the majority of the events are going to occur in that scenario. So if I can get favorable reward to risk ratio, that's my expectation of return on capital and or return on risk. In addition to favorable expectation of an outcome, of the right outcome, that's the way I want to build my trades. I don't want to just look at a stock and think, oh, it looks like it's going up. Let's put a trade on here. It's got to be much more specific than that, right? It's got to be, I know where I'm getting in. I know where I'm setting my stop. I know where I'm setting my target. I know what my expected reward is. I know what my expected loss is. And I can even go in there, depending on the broker. Now, we do have a fairly simple probability model available that I can show you. I can also show you a probability model on a trading platform. Most trading platforms will have some sort of trading probability model available for you to try to assess this. And when we can put those things together and put them in our favor, that helps us to have the confidence that we're putting the right trades on at the right time. Now, of course, market conditions play a big role. And I might stop and pause during the presentation to brag a little about the accuracy the model has had in forecasting. Our TradeSpoon model has had in forecasting this downward price action. And it's calling for some more. So we do want to be careful, right? Yeah, we had a couple of positive days. 2 days don't make a trend. Don't get swept up into 2 days where you say, oh, look, I've had 2 positive days on decreasing volume. That's not real conviction coming from the buyers. So we don't want to just jump in. Like we said, let's make sure we're getting in at the right time with the right probabilities. So how do we then take this concept of probability and apply it to technical analysis? We're going to incorporate our forecast tool. And then on top of that, we're going to be looking at the reward and risk scenarios of any given trade. I'll tell you right now, if these are not elements that you are looking at when you're building your trades. If you're in that mode of, hey, it looks like it's going up, let's slap a trade on and hope good things happen. You're basically saying, hey, let's throw some spaghetti at the wall and see what sticks. If you're not finding the results that you're hoping for, evaluate the premise. What are you trying to accomplish? And what level of detail are you giving it when you build your trades, right? These metrics, these pre-trade metrics, are critical to us. So the first thing when we think about probability of success, especially when it comes to picking strike prices, if you're an options trader, if you've ever tried to trade options, you know one of the most difficult aspects is what trade, right? What strike price? Not to mention what expiration. When it comes to expiration, you're going to base that on the amount of time that you need for whatever move you're forecasting. I'm a swing trader. My moves are 5 to 9 days. I usually add an extra week to the end just as a cushion. I've heard people say you should buy 2 months more than you need. That's crazy. Why would I ever need 2 months more for a trade that should occur in 5 to 9 days? It should start occurring in 1 to 3 days. When we trade, be specific. Have specific expectations, and it's going to make your trading stronger and better. But when I buy an option, am I buying in the money, at the money, or out of the money? In just a second here, we're going to have a little bit of a discussion on implied volatility. That's huge. As the market has dropped here over the last little bit, we've seen a swell in implied volatility. What does that mean? It means that options have gotten more expensive. Be careful if you buy options. They're going to be harder. You're paying more. The amount of time you lose per day is higher because the implied volatility is higher. That means that your probability of success, even if the model, so a probability model is not going to reflect that. We have to incorporate that. The more you pay for an option, the lower your probability of success because time is working against you more. So in that circumstance, I'm going to decide to come into the trade as a seller. Right, I'm going to look to do a bull put spread if I'm bullish, or a bear call spread if I'm bearish. I'm going to do a credit spread. But now I've got to select my strike price. How do I go about that? How do I go about picking a strike price? Well, typically, regardless of which way it goes, I'm going to go at or slightly out of the money. If I'm doing a bull put spread, stock's at 151, I'm going to sell the $150 strike, right? At or slightly out of the money. Why? Well, because if I do that, I can have a 50% probability of success. If I'm a little bit out of the money, I can kick that probability of success up to 60%. 60% of the time, the stock is going to stay above my already out of the money option that I sold. Now, I'm not going to get 2 to 1 with maximum loss versus maximum gain. It's not going to happen with a credit spread, which is why I'm going to draw a line in the sand, set a stop loss, and I'm going to minimize my risk if I'm wrong. If I'm able to do that, then in that circumstance, I'm going to end up with a favorable return on risk. We're going to look at 2 things here. We're going to look at return on capital, and we're going to look at return on risk. So the first element we're looking for is probability, right? So here, I have the potential of looking at this and saying, what's the probability of it staying in between or above or below? If you're going to get into probability, I would highly recommend that you start to use, somebody said no sound. Can everybody hear me still? I just saw a comment that said no sound. I just want to know if it's one person or everybody. So if you can still hear me, let me know. I'm not seeing any answers. Can you guys still hear me? My microphone button is moving up and down. Okay. All right. Perfect. Yep. Perfect. All right. I'm going to keep going. So let me pause here. Let me bring up I'm going to bring up a trading platform that has a probability model. So now let's take a look at Cisco. It just happened to be up on my chart. Am I bullish on Cisco? No. The drop it's taken has been a little bit too much. I'm not trying to catch a falling knife, right? So right now, in fact, right, I'll tell you guys right now, be careful. I'm thinking that we may be seeing some bear flags out there, that if this goes up on decreasing volume, we may see another drop. Okay. Let's just assume I am bullish. I'm bullish. It's 52.5. What do I think it's going to do? Well, this is my support level. What is support? Support's the last place the sellers ran out of steam, stopped selling, and the buyers started buying. It's a transition. Support is a transition from sellers to buyers. Resistance is a transition from buyers to sellers. So if I'm bullish, I'm going to usually draw a line in the sand around the most recent support level. I'm bullish because the trend is up and because I think buyers have taken control. If all of a sudden the sellers take control and they break it below the last support level, I'm wrong. So I might look to put a short strike here around this $51 mark, right? A short strike around $51. So let me go in here and just kind of throw together a little trade for you, and we'll just see what it looks like when we think about probability of success. We're not looking at butterflies today. Let's go look. If I could get my symbol in. Now I got it in twice. Okay, Cisco. Add simulated trades. Let's just go in here and build a vertical spread. And what am I going to do here? Now, if I want to build a slightly higher probability trade, I might come out here and sell the 51 and buy the 49. Right? So I can do a, let's do a 51, 49 bull put spread. And I have a trade that looks like this. Now, there's a good amount of probability that I stay above 51. This is a probability trade, right? What's the probability? Well, I can go to this probability analysis and I can say that by May 31st at 51, was it 51? Yes. At 51, there is a 80% chance. There's an 80% chance that it stays above 51. Okay, that's pretty good. 4 out of 5 times I'll make my 29 cents. But what if the one time it doesn't? So let's look at the return on, and we're going to get to the slides on this, but let's talk about return on capital versus return on risk. When I'm assessing this trade, right? Now, let me just show you. I don't think this is going to look good in here, so this is another reason why I wouldn't be bullish on this. Here's Cisco. Our model, which basically predicted this whole move down, is saying that it looks like it's going to pause and then continue moving again. So let's flip-flop this. Let me take a look at this. Let's say that we do think this is a bear flag. We're going to go more aggressive to the downside. This will be exciting. I'm going to change this to calls. And I'm still, so in this case now, I'm going to sell slightly out of the money. What would that be? So now the slightly out of the money is going to be a 53 strike. Right? So now when I sell, I'm going to sell a 53. That's slightly out of the money. And I'm going to buy a 55. So that's going to flip this whole thing. Now it's an opposite trade. And it's a little bit more aggressive. You'll notice instead of a 30-cent credit, now I'm getting a $1 credit. Much better. Big credit. I am going to draw a line in the sand. So I might come in here and say, you know what? If it gets up to 54, I'm wrong. Great. Now, if I just looked at return on capital, what is the capital requirement of a spread trade? This is a credit spread. The most I could lose on a credit spread is the difference between the two strike prices, which is $2, minus the credit, which is $1.09. That means 91 cents. 10 times $910. If you look right here, that's about 910. You can see that's where we are. That's my maximum loss. Yes? So my maximum gain is 1100. So as a return on capital, I have the ability to make $1,100 off of 900 of risk. That is a 1.22. 1.22 to 1 reward to risk ratio. I'm making more. However, for me to lose everything, I would either have to let it go above 55 and take 3 weeks and do nothing. You can see it slowly loses its money. So what can I do to change the metrics before I get into this trade? Well, one thing that I can always do to control my risk is draw a line in the sand. I said 54, but this seems a little bit off. Are my dates off? What's going on? We're at 52.44 now. Okay. Yeah, I see why I'm a little off. I just happened to pick a stock that reported earnings randomly. So here is an earnings report right there. The stock is up after hours. So it's going to look more like this. So the bear flag is still on. Great. That's fine. This thing can come all the way up here to this resistance level for me. If it can't get through that level, I'm definitely going to be looking to the downside. But let's just kind of build this as if we didn't know that earnings were coming out. Maybe it would look a little bit more like, let's go. So what would I be looking for then? In this case, I would maybe set my stop loss closer to 56. So if I get in around this 54, stop at 56, now I'm going to contain my loss. Now I'm only losing $650, right? $650 relative to $1,100 gain. That's almost a 2 to 1. Now there we're talking return on risk versus return on capital. Be aware of both levels, but risk is the most, or at least it should be, risk should be the most consistent, the most consistent element of your trading should be the risk level. When I get into a trade, I'm going to risk 1% or 2% of my net equity, of my total account value on any one trade. I don't want to have one trade with 500 of risk and another with 1,200 of risk. Murphy's Law says the 500 is going right, the 1,200 is going wrong, and you're going to be down because you allowed your risk to be inconsistent. Again, we're speculators. We don't know when we get into the trade which one's going to go right and which one's going to go wrong. So theoretically, then, they should all have the same weight when you get into the trade. Let's go back into the slides for just a minute here. One more screen. Now, another thing that we're thinking about when it comes to success, probability of success, and determining what strategy, it's going to be volatility. Historical volatility, how much does a stock move over time versus implied volatility? Implied volatility is just absolutely crucial. If you're going to trade options, it's absolutely crucial for you to understand implied volatility, which basically is how much do we think a stock is going to move over the next 30 days based on how much traders are willing to pay for the options. The more someone's willing to pay for an option, the more they're expecting it to move. It stands to reason, right? If you don't think it's going to move very far, you're not going to pay very much for it. What will cause implied volatility to swell? If earnings, if you know there's an announcement that could push the stock up or down, earnings will cause implied volatility to swell. Fear, right? What causes the implied volatility to go up? When a bunch of people start hedging and buying puts, and the market makers are like, oh, you're buying some puts? I'll raise the price. And they keep buying, they keep raising the price. That's the implied volatility going higher. That's what we've seen here in the last little bit, is a little bit of a swell, right? I'll tell you right now, that swell in the VIX is very important. It's representative of institutional hedging, and the activity is up. So be careful out there. I'll just say that right now. Until we see that VIX settle back down, be very, very careful and expect choppiness to be the flavor of the week. Now, what we're looking for is, how do we approach? Up until the last 5 days, we've had very low volatility for about 3 weeks. What does that mean? That means I can buy options because they're cheap. It means I can still sell spreads because spreads give me a higher probability of success. Think about this. If I buy a call at 50, it has to go up for me to make money. If I do a bull put spread with a short strike at 50, all it has to do is stay above my short strike. 50.01, 50.02, fine. Right? It's going to take a while for me to make my money, but the probability of success is much higher. So if you are a trader who prefers higher probability of success and you're willing to sacrifice your reward to risk ratio for it, you're going to be inclined to look more towards spread trading. If you are a guy who wants to, or a girl who wants to swing for the fences, high reward to risk ratio, it's okay if you're not right as often. You're probably going to buy more options. Although, again, be very careful buying expensive options because the market is working against you. The probability of success, even right now. So if you're an option buyer, your probability of success is diminished by what? Higher implied volatility means more expensive options. Probability of success is diminished. What do the market makers, the option market makers, do to hedge themselves in a market like this? They widen their spreads. They charge you more, right? If you haven't noticed in the last few days, give me an amen if you have, the spreads have widened a bit. What is that? That's the market makers saying, hey, you know what? There's some uncertainty out there. We're going to charge you a little bit more to transact these options. Stock too. Look at the stock. A little bit wider there as well. The market makers are decreasing your probability by charging you more for the trade. So be careful, right? All these elements are going to contribute to your probability of success, your potential risk, your potential reward. And when you put them all together, you decide, this is my style. This is what I'm looking for. Are you somebody who wants to be right 60% of the time? You're probably going to risk one to make one. You're not going to get 3-1 and be right 60. Come on. Let's be realistic. That's not going to happen. If you want to get 3-1 reward to risk ratio, you're probably going to be wrong more than you're right. You're probably going to be right 40% of the time, 30% of the time. And that's to be successful, right? So if you haven't, now one thing I'll tell you, as you think about these pre-trade metrics, the next thing that you need to think about are your post-trade metrics. If you think you're going into a trade to be right 60% of the time with a 1-to-1 reward to risk ratio, and you come out less than 1-to-1 and you're only right 50% of the time, you're going to be losing money. So you have to change that. If you don't have mechanisms to provide you the feedback necessary to assess your trading, and what I mean here is record keeping, not just record keeping, but analytics, right? This is what we teach our subscribers. You've got to keep track of how often are you trading and how often are you right? And when you're right, how much do you make? And how much are you wrong, right? What percent are you wrong? And when you're wrong, how much do you lose? And what is your empirical reward to risk ratio when you're done making your trades? And when you're done with all that, it's going to give you an expectancy. If the expectancy is positive, yeehaw, giddy up, you're profitable. Go forward, make some money. If your expectancy is negative, stop. If you're trading with live money, stop. Negative expectancy is what you get when you walk through the door of a casino. Every game you hit, negative expectancy, right? I live in Utah. You drive out to my in-laws who live out in Sacramento. I drive along I-80 right through Nevada. You get closer to Nevada, you get these billboards. Loosest slots in town, 97% payout. What did they just tell you? They just said you have a negative 3% expectancy. Now, come on in, sit down, have some fun. If you stay long enough, we'll give you a watered down drink, right? Negative expectancy. What's the difference between a gambler and a trader? The answer is a positive expectancy. How do you generate a positive expectancy? You make sure that on every trade you take, you understand your expected you understand your expected probability. You understand your expected reward to risk ratio. Comment came in. Unless we find our edge, similar to counting cards in blackjack. No, actually, I mean, it is similar, right? That's exactly, that's what we are doing. How do we find our edge? Here's my edge. Number one, I only trade in the direction of the trend on a pullback at support or resistance, in whichever direction it is. Because if I do that, I can get 2.5 to 3 to 1 reward to risk ratio. So my first edge is that I expect to make more when I'm right than I lose when I'm wrong. You're not going to find games in a casino, right? When you play blackjack and you count cards, you're still betting one to make one. 1 to 1, 1 to 1, 1 to 1. You need to find an edge that gets you right more often. So if you count cards, you can get yourself up to a 55 or 60% probability. Ironically and interestingly, there's a book written by a blackjack guy by the name of Ed Thorpe called Beat the Dealer, where he used to count cards. And the secret to his success was in his money management. The counting cards just gave him the slight edge. He had to do risk management right. Then he ended up very impolitely told not to come back to the state of Nevada. Think about who was running the casinos at the time. He switched and started doing market. He then wrote another book called Beat the Markets, I believe. Anyway, Ed Thorpe used a risk management model called Kelly Criterion. He worked with this very brilliant mathematician named John Kelly at the Bell Labs before he became a blackjack player. And so Vincenzo, I love your name, by the way, Vincenzo. You're right. You're spot on, man. You're 100% right? What's the edge? So where do I find my edge? Technical analysis with favorable reward to risk conditions. My other edge is within options, and it's called theta. I'm a theta junkie. I'm addicted to theta. What is theta? Time decay. Positive theta is where I make money from time decay, right? Price goes up and down. Time or volatility goes up and down. Price, or I'm killing myself here. Price goes up and down. Volatility goes up and down. Time ticks. 24 hours a day, 7 days a week. Like clockwork, pun intended. That's where I get an edge. Is if I'm not wrong on a trade, I'm right. Time's working for me. Sometimes faster than others, but that's it. So where's my edge? My edge is from my technical analysis, from my reward to risk ratio, and from favorable time decay. There it is, right? So when I put those together and I trade that, but in order for me to know that I have those three elements, I need to understand what is the probability of success. I need to understand if I'm right, how much do I make? And if I'm wrong, how much do I lose? I need to know what is my maximum loss and what is my expected loss based on my stop loss. And if I can put all those things together and always make sure that I am trading now, I'll tell you this. One thing probability models do not do is account for trend. So when I look at a probability model and it says 60% chance, I think it's probably even a little better than that, because I that's a 50-50 proposition. Anytime you look at a probability model from the point it's at right now, which is the left apex, it's going to have a 50% chance of going up, 50% chance of going down. I believe that if I can trade with the trend, I can buck those odds slightly in my, again, do I think I'm going to be out here and be right 97%? I always love those ads. I know you've all seen them, right? The guys who are, we're right 97% of the time, until you sign up and then you trade it and then it's wrong. And then you email them and you complain and they say, oh, well, the market's volatile. And you realize that most of those sites are really good at marketing and they're not so good at trading. Trading's a craft. It's an art. And we need to be looking at all the different dimensions of it. There are so many elements of your trading that you can refine and improve on, right? So I call it deliberate trading. With careful consideration, I approach every element. The way that I forecast the market, the way that I pick the stocks I'm willing to trade, the setups that I'm looking for, the way that I build my trade, the way that I manage and execute my trade. When I'm done executing the trade, I log it. Then I go to my log and I look at the numbers and I ask the numbers, because numbers do not lie. Right? I told you I'm a coach. I work with traders one-on-one. I start off with a nice hour-long conversation to get to know somebody. If all I had was a trade log with 100 trades that expressed the data in the way that I'm used to, I would know more about a person, more about a trader in 2 minutes with their numbers than I would talking to them for 2 hours, because numbers don't lie. People tell me all the time, oh yeah, I trade, I look for the good reward to risk. And then I look at their numbers and their reward to risk is less than 1. Well, you might think you are, but what your numbers say is a different story. So you got to make sure that you're looking at your numbers and that your numbers are telling you your story. If it's not a positive expectancy, you better start making some changes. And if we are using good record keeping, we have the ability to dive in, assess the numbers, and figure out what changes need to be made. Again, I'm a pretty bright guy. I work with my hands. I could probably change a number of different parts on my car if my car stopped working. I got YouTube, right? I can change I can fix my car. I have YouTube. But the question is, do I know what to fix? Right? Do I know what to fix? If I don't, right? I probably would, because the car computer would tell me. But I think you get the analogy. I don't want to just start changing parts on a car. Oh, well, maybe I'll change the catalytic converter or the flex capacitor. That's what I'll change. If you don't know what to change, you're just tinkering for no reason. And you have no reason to expect that those changes will lead to better trading. There's no reason to expect it. So when you start to assess these metrics before you trade, that's what we want to really emphasize here, is proactivity. Don't wait till after and be like, oh, I don't know if this is working or not. Well, you're losing money, so I would say it's probably not. Get in front of it. What are your expectations before you trade of the probability of success, the return on capital, the return on reward? Let me keep going through my slides. So again, we talked about this. If you want a higher probability of success, that's what POS is. We're not talking about your old high school car. Higher POS, lower return on capital. And again, I will tell you right now that I do look at return on capital, but more than that, I emphasize return on risk. What are you willing to lose if you're wrong? What do you expect to make if you're right? What do those numbers look like? We need to be aware of those to make sure that the trade makes sense before I get in. So before I trade, I do a lot of due diligence. Once I trade, I continue to maintain that reward to risk perspective on a daily basis. Every day it's a new trade. Every day something new might have happened. If the trade's going in the right way, I'm getting closer and closer to my target. That means I have less and less money to make. If I have less to make, but my risk is expanding, I better start adjusting my exit strategy and my stop losses in order to control that reward to risk ratio. So managing your return on risk in an ongoing fashion, right? Every day the probability shifts. Every day your return and your risk shifts. So you want to be diligent in maintaining that perspective. When it comes to return on capital with a credit spread, max gain versus max loss. What is your max gain? The credit. Whatever if you sell a bull put spread, if you sell a bear call spread, whatever the credit you collect is, that's it. That's the maximum. So if the trade goes the right way, expires worthless, out of the money, you keep it all. I'm typically looking to get at least 80%, right? If I put a credit spread on for 4 weeks and I've made 80% of that trade in 1 week, think about what's left. It's a different trade now. Don't get caught up into the mistake where you're thinking, oh, but I don't want to have to pay commissions to close it. You don't want to have to spend $8, $10 to close the trade. You're somebody who would be attracted to picking up nickels in front of a steamroller. It's free money. Come and get it. It's pretty dangerous if it goes wrong, though, right? So if I've made 80% of my potential in 1 week, think what's left. Now I have 3 more weeks to make the last 20%. So I made 80% in a week. Now I can make 6% a week for the next 3 weeks. And I can put my 80% at risk to do it. When you start to assess trades in that way, you start to realize, you know what? I should take my 80% and I should walk away. Then all of a sudden you start seeing more winning trades on your ledger. And you start seeing bigger winners because you're taking your profits sooner. You're not giving it back. And that has dramatic impact on what you're doing. So maximum gain, the credit, what's the max loss? The difference between the two strikes minus the credit. We did a $2 wide. If I have $1 credit and it's a $2 wide spread, the most I can make is $1. I take the difference between the strikes minus the credit. It gives me max loss of 1. That's 1 for 1. That's max loss versus max gain return on capital. Return on risk could be an entirely different number. If I'm going to shut my trade down before I lose half, then I'm risking 50 cents to make $1. Now I got a 2-to-1. If I can get a 2-to-1 trade and put myself in a situation where there is a 50% probability of success with a 2-to-1 reward to risk ratio, giddy up, let's go, right? Again, what we're thinking here is, what are the questions we ask before we trade? If the question you ask before you get in a trade is, how do I know I'm getting in at the right time? How do I know it's going to go up or down from here? You don't, and you won't ever know the answer to that question. You're asking a question that you can't answer for 4 or 5 days. Stop asking that. Ask these questions. Do I know where I'm wrong? And do I know how much I'm going to lose if I get there? And do I know what the likelihood of me getting there is? Do I know how much money I make if I'm right and what the probability of maximum success is? Do I know what my reward to risk ratio relative to the probability of success is? It's not about if I'm going to be right. It's about how much I make when I'm right, how much when I lose when I'm wrong. It's about expectancy. I tell people all the time, trading is a lot like my marriage. In my marriage, I have 2 choices. I can either be right or I can be happy. And when I'm trading, I can either look to be right or I can look to make money. What do you want here? You're here to be right? Okay, go find really bad reward to risk ratio trades. You can be right a lot. Then you can get crushed when trades go against you. Think about the totality of every trade. And when you incorporate the right metrics before the trade, everything gets better after the trade. Every decision you make along the way, every trade management you make as you reassess from day to day that trade, I can tell you right now, I call it the Ronco approach. You set it and forget it. If all I did was slap a trade on, put a stop, put a target, walk away, and then hope something good happens, I would not make money. I wouldn't. I make money because I'm good at managing trades, because as the trade goes up, I'm good at taking risk out of the trade. And when it hits a certain level, I think, oh, you know what? I'm gonna sell a little bit and take some profit. And then I'm gonna run a trailing stop the rest of the way. And when it gets to this target, I'm gonna sell it. And I'm gonna maximize every winning trade and minimize every losing trade. And I'm gonna use tools like the trade spoon model to help me assess these levels of how high can it go, how low is it likely to go. What am I able to do in order to build the right trade? Now with the debit spread, it's the exact opposite. What's the most you can lose is the debit itself. Anytime you trade options and you pay, that's the maximum risk. But that's losing everything, and I don't want to lose everything. So I'm going to establish some rules. I'm going to establish some rules that help me to define and better control and contain my loss levels. Then I can focus on return on risk, which is going to be an even better metric for you to pay attention to. So let me know if you have any questions. I hope the gist of this presentation really came across, and that is this: proactivity. You want to trade like a chess player. You want to think 2-3 moves ahead. Interestingly enough, I one time was teaching a professional chess player, a grand master or whatever they call it. He'd won international tournaments, and I asked the guy. I said, well, "What would you say makes you so good at chess?" And I'm thinking proactivity, right? He thinks 5 or 6 moves ahead, not 2 or 3 moves ahead. And he said one thing, and it resonated with me, and it really stuck with the analogy to trading. He said, "You want to know why I'm good at chess? He said, because I protect the king. He said, the first thing I do is make sure I'm not in a position to lose. Then I go out and I try to win. And I said, that's beautiful. That's exactly what I want to do in the market. First, position myself to not lose. That I've controlled my risk. I've defined it. I've controlled it. I know the likelihood of it getting there. Every aspect of what would it look like if I'm wrong is accounted for before I get into the trade. I look at the expectations, and I tell people this all the time. If you want to be right in trading, have more than one idea of what might happen. That's the constant mistake. People are wrong, and it's like, well, what did you think? And they thought, I thought it was going to go up. What? That's it. What if it goes sideways? What if it goes up for 3 days and then sideways? What if it goes sideways for 3 days, then starts going up but slowly? What if it goes against you, but only by this much, right? I want those what ifs. Those are the questions I want to ask to make sure I'm ready to take this trade. So pre-trade metrics will absolutely make every difference in the trades that you build and subsequently the expectancy that you're able to generate. What do we offer? At TradeSpoon, we offer simple strategies that rely on these forecasts and being able to project accurately price action. Screeners, short-term trades, long-term trades with very, very specific entry and exit prices. We try to package everything, the education, the mindset, how to manage your risk, how to put together a complete and total trading plan. And like I said, if you go to tradespoon.com/metastock, you can sign up and get a 30-day free trial, and you get access to all of our tools. Check it out, see what we have. Be thinking about these pre-trade metrics. Like I said, it integrates very, very well with your standard technical analysis. This is not a replacement. So those of you who are Metastock users, it integrates very, very well with your standard technical analysis. In fact, like I said, I'm building a house. I want to have as many reliable tools as I possibly can to get this thing put together the right way. So with that, I'm going to wrap it up, open it up for questions. And I'm not exactly sure how you want to tie this one off, but if anyone has any remaining questions, please feel free to throw them at me now.
Good job, by the way. Okay.
Thank you.
I think you missed one of the most important things that comes as part of their trial offer.
Oh, what did I miss? I don't doubt you're wrong.
So one of the things that we kind of worked pretty hard on was actually putting together a full-blown add-on into Metastock. So what it does is it communicates with the TradeSpoon service, and it'll allow you to scan anything that you want. You can combine it with your technical indicators. You can scan for the TradeSpoon statistics. It works with the expert advisor, so you can go in and see kind of what the scoring looks like, and see commentary as well. The thing that's nice about the add-on is it's my favorite price. It's free as long as you're a TradeSpoon member, or you're a member of the TradeSpoon website. So you'll be able to download that. It's all part of it, the included offer that's today. And the thing is you'll never even have to pay extra for that. So I just wanted to make sure to throw that out there too.
Yeah, no, that's fantastic. I'm gonna have to get my. I don't think I have it loaded on my Metastock. So.
Yeah, no, we'll definitely have to get you set up. I didn't know you were in Utah. That's one of the things I just learned. So, well, glad to hear you'll have to come by the office.
Oh, yeah, absolutely. I would love to stop by. Where exactly are you guys located?
We are, we're actually down on about 45th South.
Okay, very cool. I will stop by. Yeah, absolutely.
We'll work out the details later, I guess. In any case, so the offer, what exactly is it, the offer? Let's kind of go over that again.
Oh, yeah. So let me go back to there we go there.
But 30 days free.
30 days free.
Okay.
There you go.
So that includes the add-on. That includes basically 30 days access. We've been doing this with TradeSpoon for a while. The feedback I've had from people that are using it is very, very positive. So, as traders, we like that low risk reward ratio, free for 30 days. There's not a lot of downside there. So tradespoon.com/metastock. Give it a go. All right, Scott,
Yeah.
I don't see any questions coming in through either the GoTo or the YouTube console. I want to say great job today. I appreciate your time. Any final thoughts for the watchers?
No, I mean, I appreciate it. I'll tell you, for those of you who have been, especially the last few days, we've really seen some shifts that we want to be paying very close attention to. There's some signs in the overall volatility of the market that this could keep getting worse. So be careful out there.
All right. Thanks, Scott. Appreciate it. And
Thank you.
For everybody that came today, we really appreciate your time. If you're watching us on YouTube, make sure to like and subscribe to the channel while you're there. And as always, we'll see you at the next event.